Welcome back to the channel, guys. I'm your host, Buck Ning, and today we're going to give you a beginning of the week update here. And then we're going to talk about the 1/3, 2/3 concept in long-term investing. And then, we'll just talk about a few other things, but we will go ahead and update you guys on the portfolio first. So if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. And we'll just get right into it. But also, we're going to talk about why I choose indexes over ETFs, and why maybe you should consider indexes over ETFs if that is your strategy. Might get a lot of hate on this video, but hey, that's part of the journey. And so, portfolio closing out the day at $4,221.50. We were down $34.18 on the day, down 0.8%. For the week, if it loads, always having troubles loading with this one. It doesn't even load. Let's get that going. We are down $16.12, down 0.38%. For the 1 month, we are up $67.25, up 1.62%. For the 3 months, we are up $310.13, up 7.93%. For the 1 year, we are up $626.50, up 17.43%. And for the year, all time, we are up $626.50, up 17.43%. Before we get into the positions, I always want to show you proof that I did put $100 in this Sunday, which is right here. Got an itch on my ear. But yeah, it's right here. And that's just going to show you that we do put in $100 every single week. And then we invest it on Fridays, unless it's a holiday, then we do it the day before or whatever comes up and we see what happens. So first position is Bell Canada, ticker symbol BCE, closing out at $58.12. We own 8 shares of this, and it holds about 11.51% of the portfolio. Here's a quick snapshot. Again, that is Bell Canada, BCE. BMO, here it is, closing out the day at $113.86, down 1.61% on the day. We own 5 shares of this, holds about 14.09% of the portfolio. Moving on to the next one, Bank of Nova Scotia, closing out at $77.51, down 98 cents on the day, down 1.25%. We own 7 shares of this. It holds about 13.43% of the portfolio. So again, there's a snapshot. And again, that is Bank of Nova Scotia, ticker symbol BNS. Next position we have here is Loblaws, ticker symbol L, closing out the day at $69.58, down 91 cents on the day. We own 6 shares of this, and it holds about 10.33% of the portfolio. And again, that is Loblaws, ticker symbol L. Next position we have here is Manulife Financial Corporation, ticker symbol MFC, closing out the day at $27 even. We are down 1.71% on the day. We own 17 shares of this, and it holds about 11.36% of the portfolio. And again, that was Manulife Financial Corporation, ticker symbol MFC. Next position we have here is Royal Bank of Canada, ticker symbol RY, closing out the day at $117.18, down 41 cents on the day, down 0.35%. We own 6 shares of this, and it holds about 17.4% of the portfolio. Again, that is Royal Bank of Canada, ticker symbol RY. And this is the position we will be updating on Friday. Friday, I believe. Unless it is the ex-dividend date, then we will purchase it beforehand. Next position we have here is TELUS Corporation, ticker symbol T, closing out the day at $25.68, down 5 cents on the day, down 0.19%. We own 15 shares of this, and it holds about 9.53% of the portfolio. Again, that is TELUS Corporation, ticker symbol T. Last position we have here is Toronto Dominion Bank, ticker symbol TD, closing out the day at $83.12. We own 6 shares of this, total position value of 12.34%. And again, that is Toronto Dominion Bank, ticker symbol TD. As you can see in the cash portion, we have $181.19 for the purchase of Royal Bank of Canada, which we will be purchasing on Friday to increase our position from 6 shares to 7 shares. And that is the update for the portfolio. No dividends this week, but we should be receiving some next week, I believe. And here's my watch list as for right now. But we'll head back to the top and just leave it on this page here. And we'll leave it on the day because today was just, it went down, not a big deal. But yeah, we're going to talk about why I invest in indexes and the 1/3, 2/3 concept. And I know a lot of the viewers on this channel are from Canada, so I'm going to show you a chart right up here. I'm going to pop it right in front of my face. And what you're looking at right here is the Canadian Equities S&P TSX Composite Index for the annual returns. And the concept of the 1/3, 2/3 rule, not a rule, just a concept, is that 2/3 of the time, you will get a positive return annually on your investment when you're indexing. And I'm just using, the composite for the S&P, or sorry, the TSX. And this is for the Canadian market, the Canadian equity markets. And so as you can see, it has the years listed there. So on the blue, that is your positive. On the red is negative. And at the bottom, you can see a little bit of the graph. In the center there, it's anywhere from 0 to 10%, anything. And then the next column moving to the right is 10 to 20% returns, and 20 to 30% returns. In the third column, fourth column, 30 to 40% returns, and 40% returns in the last column. Moving to the left is a 0 to negative 10% return, and negative 10 to 20 and 20 or less going to the left side. So the 1/3, 2/3 concept is for long-term investors, of course, when it comes to indexing. And I always talk about indexing because I just find it a bit more lucrative in my eyes than ETFs. And this is why I purchase indexes, not in this portfolio specifically, but indexes in general. But no, I don't actually own any Canadian indexes. I actually just use the S&P, which we'll talk about later. But this is just to give you an idea of long-term investing so that we as new investors, or even experienced or seasoned investors, we understand that fear is real. FOMO is real. And to ride out, downturns in the market or market crashes, to always ride them out. As you can see in 2008, which is on the far left of this document, was a negative 20% or less. I can't remember what the exact number is. That was a negative return year. And I'd imagine a lot of people got very scared when it came to 2008. That was the financial crisis. But if you go to almost the far right in 2009, you had a return of anywhere from 30 to 40% if you rode out that year. And this is where dollar cost averaging comes into play. This is where continually investing on a consistent basis pays off for this specific reason. But you can see a lot of those examples in this. You can look at 2002, which I'm not sure what happened there. But 2002 was a rough year. But if you go to 2003, again, in the same column of 2019, you have a 20 to 30% return. And then what's another one? 2015, rough year. 2016, positive year. But you can see, I know the numbers are kind of jumbled up here, but you can see sometimes consecutive runs, like a bull run that happens in the marketplace in Canadian equities as well. 38, 39 wasn't around that year, but let's go like, let's see here, 2012, 13, 14, 15 was a crash. So we had almost a 3-year bull run there. 16, 17, 18 was a negative year. 2019, and 2020 was a positive year. 2021, not so much currently, but it is just volatile right now. But you can see how 2/3 of the time, if you stay invested for the long term and continually invest, you will realize the gains. You will be happy with the gains, and you just need to accept the losses in that year and just stay steadfast to your plan. And so that is the Canadian Equities TSX Composite Index for those that invest in the Canadian index. And then the next one that we have here, I'm going to pop that one on screen as well, is the US Equities S&P 500 Index for annual returns. And it's the same chart, but just the S&P 500. And you can see a similar thing where 2/3 of the time, for the amount of time that you're investing I'm talking like 5 to 10 years, even past that, you see 2/3 of the time you have a positive return, and 1/3 of the time you will have, maybe a loss in value in your portfolio when it comes to indexing. But, you know, that's why we stay invested for the long term. We don't want to try and time the market. Timing the market is a strategy that I just don't see working for the most part. And so that's my take on it. But um, the longer you invest, the less risk over time you are taking with that index. So let's say you are in an index for like 10 years. I know the S&P on average, even if you have a year that's maybe 1%, 5%, 15%, it averages out to about 14 or 15% per year. And that's just taking the average. So in a time where the market dips down, understand that if the market dips down like 10% or yeah, I think that's the most recent one, 10%, like 2018, anywhere from 0 to 10%, all those years that you've been making a gain of, for anywhere from 0 to 15% on average, you're almost still up in the index for a portfolio or whatever it is you're doing. So that is just to show you the 1/3, 2/3 rule to get you thinking. It's not a rule. I keep saying that it's not a rule. It's a concept. That 2/3 of the time you will see an increase in your portfolio if you're just indexing. And this is why I recommend indexes for myself. But something maybe you should consider. I'm not a financial advisor. I'm definitely not your financial advisor. So don't take my word on it, but go seek professional advice. But it's just to give you an idea of what it means to invest long term and see the returns of investing for the long term. And so 1/3, 2/3, as you can see, you can just eye up those graphs again, and you can see that 2/3 of the time you will have a positive return, and 1/3 of the time you'll see a downturn maybe in your portfolio, just based on the market or the economy or anything of the sort. And so hopefully that makes sense, and why I personally choose indexes, but specifically the S&P, because usually the fees on indexes are much lower, and so that's why I choose indexes. So long-term investing, if you're not interested in picking your own stocks or doing that sort of thing, but yeah, that's what I really wanted to talk about. Just another thought to think about, or an idea to chew on, and just like really educate yourself in that area. And so, and just remembering that, maybe you started investing this year and you're not seeing the returns that you thought you would see because of last year's example, but the past is never a reflection of the future. But understand, the longer you invest, you will capture 2/3 of the time the gains, compared to the losses, which is 1/3 of the time. And I'll take those chances over gambling on some random stock. But I also, so that's that. But I also wanted to address one thing here, guys, and that's diversification. I've been getting a lot of, well, not a lot, but I've been getting comments that are hinting to me that maybe this portfolio is over diversified in the banks or anything like that. And they're always talking about, I think it was Enbridge. I always see a lot of Enbridge in the comments. And the only reason I think I see Enbridge is because people are so attracted to the high yield that Enbridge offers. And then another REIT. And I did a video on REITs and why I'm not considering REITs currently. And so if you want to check that out, then please do. And no fault of their own. They look at, the portfolio, and it's not judgment. It's just analyzing. And I get that. But I hope that new viewers and maybe new investors and seasoned investors can hopefully understand that everyone's goals are different. Everyone's idea of a portfolio is different. My idea, well, I don't own Enbridge. I used to. I don't anymore. And a lot of people do. I'm not going to cast some sort of idea that Enbridge is a bad idea because it's a high yield and it's very attractive. Trust me, if my goal was to make the highest yield portfolio possible, I would. But that's not my goal. That's not my idea of a stable portfolio having a very high yield. I mean, I've seen yields like 13%, but they're not attractive. I don't know what they do. And it's just not something I'm, attracted to for putting in a portfolio. And so if your goal is to have the highest yield possible, please, you have every right to do that. You have every right to have an opinion. I'm not casting judgment in any way, shape, or form. But the idea for this channel, for this portfolio, is just to show people, the journey on building a dividend portfolio. I'm not telling anyone to buy this and buy that. I'm just giving you real life example and like almost like a journal of where it's going and where it's heading when it comes to this portfolio specifically. And the one thing that I can compare every investor is different, is golf. If you watch golf, and this idea, maybe you don't watch golf or maybe you do, there's a golfer and his name is Bubba Watson. Bubba Watson has one of the most unique swings in the PGA to ever be seen. He is not your common, it's not a common swing that you see. It's not, I guess, the normal way people swing their golf clubs. Bubba Watson has this very unique way of swinging, but it works for him, and he's on the PGA. I mean, I can't say that one person, you have to swing this way and you have to invest this way. I'm not that person. I'm not going to be that person. I'm not a financial advisor. I'm definitely not your financial advisor. And so I want to make that very clear. But if you look at Bubba Watson compared to maybe like a Tiger Woods, their swings are completely different. And to be honest, Bubba Watson's swing is the most not unorthodox, but just not the way that a lot of people think that you should swing based on common knowledge of swinging a golf club. He doesn't swing like regular golfer. He swings in a very different way. And that sounds funny. I don't know if that's going to get in trouble, but it sounds funny. But that should go with investing as well. There are new investors that are on here on this platform trying to just learn about investing. And there's seasoned investors that come on here to maybe do some research. I'm not sure. But please just be cognizant that there are new investors, and a comment that says do this and do that, or you're over diversified. What does even diversified mean? Because an ETF could have all banks in it. Is that ETF over diversified? I'm not sure, right? The S&P 500 has 500 companies in it. Is that index over diversified? So what is over diversified? What is diversified? I think if you understand the definition of diversified, or then maybe sure, if you're looking at it as common knowledge or common practice in the industry. But what if someone just likes bank stocks? What if that's all they like? What if someone only likes tech stocks, like Tesla, Apple, Microsoft? What if that's all they like? Are they under diversified? Are they not diversified enough? What if someone just likes REITs? REITs is just real estate. Are REITs over diversified or under diversified? Because there's probably, not REITs, but ETFs. They have like 10 different companies in there sometimes. I mean, look at the ARK ETF sometimes. How many of those companies are tech companies? Would you say that fund is over diversified? I'm not sure. And so when people leave comments like that, I fear for the new investor, because yes, on the surface level, this is what you see. My thing shut off so you can see a bunch of things, but I just want you guys to know that if you're a new investor, don't be scared. Do what you got to do, because it's a learning experience. We've all lost money. There's not one person who knows it all, and there's not one way to invest. The way you invest is something that applies to your goal, what you're trying to achieve, and moving forward. Whether you invest 5 to 10 years, whether you invest for 2 years, whether you're a day trader, whether you're looking for fast returns, whether you're looking for high returns, high yields, and things like that. I'm not looking for high yields. And so I just want to make that very, very clear. And so if you're a new investor and you're reading the comments and you're like, wow, I don't know what to do now because now I'm kind of confused. Do you in an educated, researched way? Like, do your due diligence in the company you're investing in. Don't go buying things because someone said this, or this is the next penny stock that's going to go 50%, 100, 200%, or buy this because this just happened, or do your research. Buy the companies that you want to buy in, that you believe in. I'm not saying that I'm invested heavily into bank stocks. Sure, a lot of the majority of those stocks in this portfolio are bank stocks, 100%. I don't disagree with that. But what I'm trying to say is just be very cognizant of other investors, new investors, and don't hinder them by making comments like that, because it could hinder them. And so please, and your feedback is welcome. And no offense to anyone if I did offend anyone. But other than that, guys, that's all I really wanted to say. I know I kind of went on a spiel, but that's why I invest in index. This is why you invest the way you want to invest, but do it with your due diligence. I'm not a financial advisor. I'm definitely not your financial advisor. I'm just a guy on YouTube building a dividend portfolio for myself, for this channel, to show people, to educate people in a way to make it easy, to really show that it's not as scary as some people might think it is to invest. And it's a learning. It's always learning. You're going to be making mistakes along the way. And so other than that, guys, have a great week. I hope you guys did enjoy the video, and we'll see you in the next one. Bye.